Hello everyone, it's Mayor the Peeps Coda. In my previous video, if you have watched, I showed out the table of content, what we are going to talk about in the next video, which is what I'm about to do now. So, for me not to waste much of the time, let's go straight to the point because I'm not going to make this video too long. So let's just go straight to the point. So, over here, the table of contents we have, what is the Forex market? Why trade Forex? Thirdly, debunking the facts and myths of Forex trading. Fourthly, major players in the Forex market. Fifth, currency pairs. Number 6, trading sessions. Number 7, what is the best time to trade? And number 8, trading style. So these are the subhead that we are going to cover in this video. So let's proceed. What is the Forex market? The Forex market, otherwise known as the currency exchange, is a marketplace where national currencies are bought and sold at the exchange rate determined by current supply and demand. Okay. Further notes, according to Wikipedia, the foreign exchange market averaged a whopping 6.6 trillion per day in April 2019. $6.6 trillion per day in April 2019. This invariably makes it the largest asset in the world. That is under what is the Forex market. Now, what is Forex itself? Forex, also refers to as FX in short, stands for foreign exchange. It simply means exchanging one currency to another. I come again. What is Forex? Forex, also referred to as FX in short, stands for foreign exchange. It simply means exchanging one currency for another. We proceed. Why trade Forex? The Forex market is unique, and as such, it attracts millions of traders daily who are busy making money online. Below are a few advantages of trading Forex. Number one, under why trade Forex, under the reason of trading Forex, the advantages of trading Forex. Number one, high liquidity. Forex is the biggest market in the world with a trading volume of over 6 trillion a day. As such, one has instant access to money as you can buy or sell your investment quickly and at a fair price. Please, if I'm too fast, you can make the video slowly for you or you rewatch it again. 2. Trading round the clock. As opposed to any other financial market, the Forex market is open 24 hours a day, 5 days in a week. That is 22 o'clock GMT Sunday, 22 o'clock GMT Friday. And as such, you can make Forex deals whenever you are online and at any time, day or night. This 22 o'clock is probably at 10 o'clock. 10 o'clock market open 10 o'clock in the night on Sunday and then closes 10 o'clock in the night on Friday. That makes it 5 days in a week. 5 days in a week. We proceed. Number 3, trade in any direction. In the forex market, there is always a potential to make money, be it in a falling or rising market. One can trade long, that is buy, or trade short, that is sell, without any limitations. We proceed. 4, freedom to choose when to trade. It is always your choice to choose when and how to trade. The market is there for everyone, 24 hours a day, 5 days a week. You don't have to leave your house or face a query by any boss. All you need is a smartphone, laptop, and an internet connection. We proceed. Now we are done with why you should trade forex, reason why you should trade forex, or advantages under why trade forex. Now we are into debunking the fact and myth of forex trading. Now it begins to make sense. From here, it begins to make sense. Debunking the fact and myths of forex trading. If you should understand, or if we all understand, that fact is something that actually occurred, a statement presented as objectively true, a thing that is known or proved to be true. That's fact. So here I'm going to open up the fact and myths of forex trading for you guys. Now, as we all know about myth is something, let me just say, a misconceptions that mislead new traders, such as believing forex is an easy get rich quick scheme. You understand me? So this is not to chase you away or make you feel discouraged about trading. This is all what you need to know before going into forex trading. Let's proceed. So number 1 fact here is losses are inevitable. Losses are inevitable. This is not to scare you away, but to be more realistic with you that the very nature of trading is that you win some and lose some. No trading strategy is lose free. Any claim that a system or indicator trading robot can deliver 100% all of the time is false and indicative that is a scam. We proceed. Fact number 2, forex trading requires time. Forex is not about how much money you can make, but about how much time you can invest. The money will take care of itself. So you agree with me that the trader who commits 4 hours per day to studying the market is going to develop faster than the trader who only devotes 1 hour per day. This invariably means that you have to spend the time and money educating yourself to become consistently profitable as you would with just about any career path. So fact is telling you that the fact about forex is telling you that losses, trading requires time, losses are inevitable, trading requires discipline. So before you jump into trading, you think of going into Forex trading, you should know this at the back of your mind. We proceed. Forex trading is repetitive in nature. That's the number third of fact. Forex trading is repetitive in nature. Forex market has a behavioral attitude that drives the market, and it is known as pattern. This kind of behavior happens occasionally, and if you are able to see it playing out, you have got the fox right in it then with massive profit. What I'm trying to say here is there is a pattern. Forex is a pattern. Forex trading actually repeat itself. There is a pattern that repeat itself. And if you are able to see it play out immediately, that means you are lucky to catch a big move in the market. It's a pattern that can play out today, tomorrow, next tomorrow, and then once you see it, as long as you have mastered the techniques and the, let's say, technical analysis, you can make massive profit from it. That's a fact about Forex trading. Also, there are market levels and areas of interest that, once identified correctly, one could easily predict market movement to a high degree of accuracy. So that's all for fact. Let's get into the meat. Now, number one of meat, trading is too risky. Yes, in life, every decision we make carries risks, be it eating, drinking, or driving your car. The only thing is that the level of risk varies. Even when you put your money into a bank account, there is risk. There is a risk that the bank will go bankrupt, leading to you not seeing your money again. The risk associated with forex trading is only as high as your risk management plan. We will teach about this later on. Let's proceed. Number two, trading forex is easy. Yes, this is what they keep saying online. Trading forex is easy. You can use $100 to make $10,000 in a week, in a day, making you feel like, oh, I need to put my savings, I need to put my house rent, I need to put my school fee. No, it is not that true. It is not that true. It is not that easy as they are making it look. Now, making money from forex trading, indeed, even making a living from forex trading certainly is possible, but the idea of it being easy and quick is not true. Most especially when you go to YouTube, you watch all these traders flaunting things online, luxury wares, luxury cars, luxury houses, and they'll they'll make it look like, oh, they woke up one night and then boom into forex trading, boom, they hit it big. Most of them spend 5 years, spend 7 years to master their risk management plan, because that is the most important thing in the forex trading. You need to master your risk management. Your risk management plan must be intact. You must be disciplined about it. You must not do more than what you plan to do. That's it. So I continue. Like any skill, it takes time to learn the techniques and strategies involved in trading. You cannot get a child in 1 month by impregnating 9 women. Patience is the language of the market. We proceed. The third one, forex trading is random and complicated. Many tend to see forex as a game of luck. This cannot be further from the truth. Though forex trading is a game of probabilities, with the right application of a few trading tips on technical analysis and effective risk management. Here it comes again, effective risk management. One would see that the trading forex could get boring as it is re- repetitive in nature. So we move on. That's it for debunking the fact and mix of forex trading. So we move on to the next one. Major players in the forex market. These are the major players in the forex market. We are going to talk about some of them. Central banks, commercial banks, hedge funds, firms, institutional traders, individual traders. We proceed. Central banks. These are the national financial institution. Okay, I come again. These are the national financial institution that oversee, please be mindful of this, that oversee and manage the currency of their respective countries. They maintain currency reserves and can intervene in the forex market to defend or weaken their national currency as they deem appropriate. Examples are the Federal Reserve Bank, the banks of England, Japan and Canada, the Reserve Banks of Australia and New Zealand, the Swiss National Bank and the European Central Bank. We proceed. Commercial banks. These are typically large commercial and investment banks that make foreign exchange quotes to other market players. They are popularly referred to as the big banks. A couple of these banks include Citi, JP Morgan, UBS, Barclays, Deutsche Bank, Goldman Sachs, HSBS. The HSBS stands for Hong Kong and Shanghai Banking Corporation, and lastly, Bank of America. We proceed. Multinational companies. These companies these companies are not in the business of trading forex, but are typically hedging and managing the currency risks that arise as a result of their fundamental commercial activities. So these companies are not in the business of trading forex, but are typically hedging and managing. Hedging is a risk management strategy like buying insurance to protect against potential financial losses from unfavorable market movements. Let's say you take a second investment that should perform well if your main or if your first investment performs poorly. For example, an airline buys fuel futures to a price, protecting profit if fuel cost rises, but also missing out if fuel prices drop. So that's it for multinational companies. Now, investment or hedge funds. These funds employ traders. These funds employs traders who actively speculate in the forex market and act as clients of large market makers. Some hedge funds execute trades automatically on an algorithmic basis. Hedge funds is a private pool of investor investor money that a manager uses to make investment. For example, like Bridgewater Associate, those are hedge funds. Another example like Elliott Investment Management, those are examples of hedge funds. So that's all for hedge funds. Let's move to the next one. The online forex brokers. These are firms that serve as intermediaries between retail traders and liquidity providers, as they offer a platform for which retail traders can buy or sell different financial assets. Forex broker exists to make it easier for you to connect with the banks out there that are buying and selling currencies. They offer specialized software. Forex broker offer specialized software like MetaTrader 5, or you call it MT5, for analyzing market, placing orders, and managing your funds, your position. You can, with the help of MetaTrader 5, you can manage a position up to 5, 10, 15, 20 position. It helps you buy and sell currencies. That's it for the online brokers. Individual or retail traders. This portion of the forex market is made up of traders that bank on short-term movements in currency pairs to make a profit. The number of speculators typically increases as market volatility increases. It is called speculation because of the uncertainty involved, since no one can know for sure whether a currency pair's price will go up or down. So the retail traders only rely on short-term movement in currency pairs to make a profit. So we move to the next one. The next one we have here, currency pairs. As earlier stated, the forex market is all about buying or selling of one currency for another. There are three types of currency pairs. These are: 1. The majors. The majors include 7 pairs, which are represented by a quote of the US dollar and a currency of one of the world's most significant countries. They are the most stable currencies. The major are Euro USD, that's the Euro US dollar; GBP USD, British Pound US dollar; AUD USD, Australian dollar US dollar; NZD USD, New Zealand dollar US dollar; USD JPY, US dollar Japanese yen; USD CHF, US dollar Swiss francs; USD CAD, US dollar Canadian dollar. The next one is the crosses. These are currency pairs which exclude the US dollar. They are less active than the majors. The crosses include CAD JPY, Canadian dollar, Japanese yen; CHF JPY, Swiss francs, Japanese yen; EUR AUD, Euro, Australian dollar; EUR CAD, Euro, Canadian dollar; GBP CHF, British pound, Swiss francs; GBP JPY, British pound, Japanese yen; NZD JPY, New Zealand dollar, Japanese yen. The exotic pairs. National currencies of less significant countries together with a major currency make exotic currency pairs. There are a lot of them, which include USD RUB, US dollar Russian ruble, USD MXN, US dollar Mexican peso. As you can see it there. So those are the few exotic pairs that we have. So I'm going to end this video here due to time limitation. I believe we have covered a lot, and we will continue in my next video that I will be uploading next week. So I believe we have covered a lot from the outline we have here. We have covered up to 5 subhead. So we'll continue from here in my next video that I will be uploading next week. Thanks for watching. Please subscribe to my channel for more videos. Turn on the notification bell, like and comment, and also share. Thank you. God bless you. Peace out.